Good day, class. This is our follow-up lecture on what we have discussed last time on farm planning and budgeting. But this time we will discuss more on the budgeting side, but the budgeting in a way that uh, focus more on the performance analysis. No, so performance analysis can be done on a per farm basis or per enterprise basis. But this time, the performance analysis will be focused on technologies. That means agricultural technology is the focus in terms of like you are trying to assess whether a technology is doing good or doing uh, economically desirable performance. Now, in this case, we will focus more on the case of vegetable post-harvest technologies. No, so to start with, we see that um, we have the importance of technologies in terms of desirable performance, may it be economic or financial analysis of technologies. Now, we will be looking at how how will how will a technology, agricultural technology, be considered as a desirable one or like economically beneficial to the entrepreneur? Okay, so we will look at uh, how we're going to use a technology. According to John Maynard Keynes, in looking at the economic or financial analysis of agricultural technologies, we um, Keynes said that we must study the present in the light of the past for the purpose of the future. That means we use past data to to cast it forward and see what happens in the future. So that is a very classical, say, articulation of John Maynard Keynes in terms of how we can use a the past data to forecast what's going to happen in the future. Now, the pinnacle of farm planning and budgeting is performance analysis. Depending on the nature and scope of the planning and budgeting cycle, performance analysis can be expressed in either physical or monetary equivalent units. Okay? Pwede siya physical, pwede pag monetary equivalent units. So, in other words, we can only assess the performance of like an enterprise in the budget planning and budgeting cycle if we go thus far up to performance analysis. So, performance analysis also can be expressed in terms of economic or financial values. Now, we need to dissociate or delineate what do we mean by economic values and what do we mean by financial values. Depending on the nature of and purpose of the analysis, financial values are cost of resources valued at normal market price. I'll repeat that. Financial, for purposes of analysis, financial values. Okay, if it is based on financial values, these are the cost of resources valued at normal market price. But that means the price existing in the market. Things you can see every now and then, the price. While economic values are prices of input and output using the opportunity cost of either the input or the output. In other words, the economic values is of economic values are cost of resource that is based on opportunity cost of that particular resource. Say, for example, you, in the case of labor, and then you devote your time to your enterprise. Okay, you devote your time to the enterprise, and then when you devote your time in the enterprise, you cannot value, okay, you cannot value your labor equivalent to, like for example, 500 pesos per day. Why? Because you are receiving in the alternative value of your labor or your time is more than 500 pesos a day. That means to say, you cannot just charge the wage rate of your uh, time spent in the farm in terms of what is nominally existing in the common market, like wage rate, 550 pesos per day, because the the alternative price or value of your output or your time is actually based on what your expertise is actually. In other words, that's the the amount that should be forgone, the price or the cost that should be forgone if you, for example, devote your time to the farm. Okay, so that means your labor is worth more than your daily wage in the in your farm. It is actually based on the alternative use of your labor, which is, for example, if you're a bank teller, so what's how much is a bank teller receiving per day? So that should be the economic value of your labor, okay, of your time spent in the farm. That's why it's not uh, desirable that when your business is still very infant or very young, very new, that devote ka agad full time depending on the paying capacity of the business. More often than not, you let others manage for you and you work maybe someplace else and you establish network so that it can support your business. Okay. Moreover, what do we exactly mean by financial price and economic price? Okay? As we have said, financial price are actually values of report of resources, okay, either input or output. No, these are values of resources that are based on nominal or existing price in the market. For example, if fertilizer is sold at, like for example 2,800 per bag, so in the market, for example in agrivet, so that's the price of fertilizer, financial price. But if you get, for example, the economic price of that fertilizer, if that particular price of fertilizer is imported, that means to say you get the import parity price of that fertilizer from its source. If it is priced there something like higher than the price that we have in the Philippines, then that should be the price used for fertilizer in terms of providing economic values. There are also cases where even if it is imported, the price there, for example, rice, the economic price of rice actually is not 50 pesos per kilo. If that rice is coming from Vietnam, now that particular price of rice is actually based on what is existing in Vietnam. Because we imported that, that means there is an import parity price. You deduct import parity price or import parity cost until you reach the pinanggalingan ng rice na yan. In Vietnam, for example, if it only costs there 27 pesos per kilo, that is the economic price of rice. Okay? Feeds, same thing. What are the ingredients of feeds? Abaca fiber. The abaca fiber in our in the Philippines, for example, is worth, like for example, $1. Actually, the export price of abaca fiber is maybe $3 to $4 a kilo. So that means the economic price of abaca fiber is what is existing in the global market. While, for example, abaca fiber here in the Philippines, it's nominally priced at $1 per kilo. Something it's relatively high already. The same is true with other resource, tractor, farm. farm labor. Okay? So itong farm labor is really very very tedious. Kukutuhan talaga yan. Why? Because you have to know, for in the case of farm labor, you have to know, or at least understand or identify rather, whether that labor is skilled or unskilled. Okay? Because the economic price for skilled labor, like for example welder, there is there is a global price. There is a world price for a Monday of welder, or a Monday of like person, for example, fruit picker, okay, fruit picker, say whatever, pineapple or something like that. So the nominal price in the Philippines usually is very low compared to the uh, global or world price of that particular piece of labor. If he works there, he will get more price. Kaya mga worker natin nag-abroad talaga because of the high, uh, say for example, wage rate abroad. So in the computation of economic in economic income statement, or financial income statement, or something like that, or economic rate of return, or economic or financial rate of return, we need to be very particular about, are we using the right values? Are we using the right price? Okay. The thing is, if financial price, we use nominal values. If economic price, we use the world price, or the opportunity cost of that particular resource, whether input or output. So that is the delineation between the two. No? So, kanina, sabi, skilled or unskilled. Well, if unskilled, that particular type of uh, uh, labor is only available or is only used in the Philippines, well, you can use the nominal price of that particular labor that is existing in the Philippines. No, so that you can use that, but more often than not, labor is a tradable commodities that is it's also existing in other countries, or in places where there is demand for that particular labor. Kaya very very fluid kaning pricing or valuing of goods and services from the financial point of view to the economic point of view. Okay? But may it be financial or economic, the same method of viability test uh, analysis used. It only differs in the magnitude of the amount, but the procedure is just the same. Like uh, whatever performance analysis you might use. Okay, depending on the nature and purpose, financial analysis is used to assess individual firms' performance or technology from the lens of nominal market price, while economic analysis is used to assess the performance of a technology or enterprise using prices, using economic prices or values. Okay? Magkaiba lang sila sa valuation. Pero in terms of like tool of analysis, pareho lang. Okay? Siyempre, iba-ibang values because we are looking at the the like opportunity cost of that resource against the uh, market price or nominal market price of that resource. Okay? Or comparably, no? So, economic and financial assessment of technologies consists essentially of measuring how adequate and how efficient an existing technology or systems has been in achieving the objectives of the farm enterprise over some past operating phase or cropping season. Okay? So, either economic or financial assessment, it is actually uh, measuring the adequacy of or an efficiency of how a technology is or technology systems has been very useful in achieving the objectives of the farm enterprise over the past operating phase or season or what have you. No? So let's start with the determinants of economic or financial viabilities. So we have here profitability. and we also have cost requirements or risk factor. Okay. Now, when we say economic and financial viability of technologies, we mean that there are costs that are discounted or there are costs that are undiscounted. Now, what are production costs? Okay, what are production costs? Production costs are some of the values of all inputs and factors used in the production activity. That's obvious. Okay, that's obvious. Only only those that are actually incurred in producing the output generated in that period are included. Those that are actually included, no, are generated in generating that output. Like for example, land, we use land rent because hindi mo naman makonsume yung land entirely for the one season. You only charge your operation with land rent, labor, wage rate, capital, interest on capital. Okay, so we we go first with the fixed and variable cost. Okay, now what are fixed and what are variable costs? Now, fixed costs are items that do not vary with levels of production. That's of course from the word or from the name fixed cost. It does not vary with the level of with the production level. It remains constant in that particular production or cycle. Okay, like depreciation, like land rent. You whether you apply how many bags of fertilizer, the land rent is still the same. And depreciation also of that particular equipment in 1 year is also given the same values. It does not vary with the levels of production. Now, another is variable cost. Variable costs are items that vary with levels of output. If you increase if you want to increase yield in that particular season, then you like increase your variable cost. Yeah. In other words, as you increase this particular resource, you will also change the volume of production, like fertilizer, seeds, water, etc. No, so this it's really something that goes with the trend or behavior of your production cost, production volume. Now, what about cash and non-cash cost? Okay, for cash cost, okay, for cash cost, we actually we actually refer that to the out-of-pocket cost. That means the cost that actually involves actual money coming from your own pocket. Okay, like for the money you buy for fertilizer, the money you buy for chemicals, and so on and so forth, and such and so. While non-cash costs are not the out-of-pocket type of cost, like you pay for the share of the harvesters that is in kind. You just deduct it from the you just deduct it from the total volume of palay harvested. Exchange labor, these are non-cash cost. Okay, and even family labor, these are non-cash cost. Okay, you just have to attribute, you just have to provide values into it, and that becomes a a real cost, as if you actually pay that, but it's only for attribution or for accounting purposes. Okay. Now, what about interest on investment? Okay, interest on investment. When we talk about interest on investment, this is actually the foregone income or opportunity cost of capital. If you borrow capital or if you get access to a certain amount of capital, what will you do? You pay interest in using that particular capital. It can either be applied to variable or fixed cost, because if fixed cost you use the machinery, then and then you buy that for uh, you use that for buying machineries, then the amount you paid for the capital for in buying your machinery is the interest, which is actually a cost of capital. But you also charge yourself with depreciation in using a particular machine. That's a separate cost. Okay. For a variable interest on investment, it is simply done by multiplying the amount of money spent on operating expenses by the prevailing interest rate in the bank. Like for example, you get a loan from the bank to buy fertilizer. Okay, so of course, the amount you use for buying fertilizer times the interest rate is the one that you are going to pay for, or shall we say, uh, you have the interest on that particular capital, which is going to be paid at the end of the no, at the end of the season. Okay, you pay for the fertilizer cost, and then you pay for the interest expense for the capital that you use in buying fertilizer. Okay. Now, interest then is computed in terms of, for fixed cost, interest of investment is computed as original cost plus salvage value over 2 times the rate of interest. That's how to compute the interest of capital you use in buying machineries. Okay? In the use of machineries, you pay uh, depreciation. That's always fixed cost. And then, what about the interest rate? That is the interest rate because you use the money to buy that machine, so you pay the interest, which is also interest on investment or interest on fixed cost. The money you use for buying machineries, where I is fixed interest on investment, R is prevailing interest rate in the bank, OC is original cost, and SV is salvage value. Okay? Sorry, excuse me. Depreciation cost then represents, I was talking already about depreciation. In the previous lecture, I also talked about depreciation. Assuming all the while that you have this particular term understood in your previous subject, but let us just treat them more specifically in the case of agricultural production. Okay? Now, depreciation represents the wear and tear cost in the use of fixed item like tools, equipment, machineries, building, etc. No? Now that is the wear and tear cost of fixed investment or fixed assets is actually depreciation. It captures the decrease in value of the fixed asset as it is being used in the farm operation. Okay, depreciation cost is really accounted for accountants accounting purposes. No, why? Why is it said that depreciation cost is accounted for accounting purposes or accounting accuracy? Why? Because actually depreciation cost is cost not using actual money. Imo lang nang i-attribute. You charge depreciation in order to be able to come up with the real or actual or proper accounting of your income or your financial statement. So you just deduct that without having to transfer actual amount of money because that is just a computation of value which will be deducted in the income statement or cost and return analysis. So depreciation cost can be either straight line, double declining, and you have also sum of the years digit method. Now for straight line, it's straight away. You have this particular formula, and then you have the the acquisition cost, which is C, minus salvage value over lifespan. Constant. Now you have that particular ano, depreciation charge. If it is if it is 10,000, the cost of capital is but the 12,000, the cost of that particular fixed asset is 12,000. And then you assign, for example, at the end of the, now it can last up to 10 years. And then at the end of 10 years, pwede pa siya mabaligya og 2,000. So that means to say 10,000 minus 2,000 because 2,000 is salvage value. All over lifespan, like 10 years. So that means 10 over 10, you charge 1,000 for depreciation every year. Okay? You charge 1,000. And that 1,000 depreciation cost using straight line goes directly into your income statement as fixed expenses that will be deducted sa imong gross margin. Okay. Now, the other one is the other one is straight line method. The alternative formula is cost minus salvage value times rate of, for example, depreciation uh, is the percent depreciation per annum charge. you charge 10%, so you always charge 10% like every year. If it is straight line method, no? So up to 10 years. So there is what we call also as double declining balance method. What does it mean? Very straightforward ni, no? Or ito. It's this particular method is applied for a certain use or certain asset where it is appropriate to deduct higher depreciation at the initial years, and depreciation is going to decrease as the asset age through time. That means to say, bago pa, dagko na siya depreciation. Like for example, machineries, first few years, dakog depreciation, and then something like that. Decline as the years go by, no? So you can use this, say for example, double declining balance method, which is annual depreciation is equals to the total cost times the rate, okay? Or the times the rate or the percentage depreciation that you are going to deduct. Okay, that means kung magagamay ang imong cost, acquisition cost, because you deduct depreciation charge every year, through the years as the asset age, the depreciation cost will also decline, will also decrease. So that is the technique there, no? Until the end of the year, until the end of its lifespan, zero value ang imong asset, no? So you have here also another method of depreciation computation is sum of the years digit method. Okay, you have annual depreciation minus is equals to acquisition cost minus salvage value times a fraction. Okay, you have here a fraction of the uh, sum of the years digit. For example, if the say for example if the uh, uh, machinery we are talking is going to last for 10 years, from the name sum of the years digit method, that means you add 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 7 plus 8 plus 9 plus 10. You sum that up, that is 55. Okay, sum of the years digit, 55. That means to say your remaining lifespan, okay, remaining lifespan is what? Uh, you have, kung bago pa, 10 years. 10 over 55. Because that is sum of the years digit. That means, ang imong depreciation charge is that you have acquisition cost minus salvage value. Kung 12,000 na siya, minus salvage value at the end of 10 years, which is 2,000, you have here 10,000. 12 minus 2, 12, 10,000. Times, for first year, what will happen to this fraction? For first year, remaining lifespan, kuan pa na, 10 years man. So 10 over 55. Pag next year, what? What will happen? 9 over 55. Third year, 8 over 55, and so on and so forth, and such and so. Okay. So that is the the way to compute for sum of the years digit method. Okay. Take note of that particular. Very easy to follow. Okay. Now, what about cost of farm family labor or family labor? Okay, the cost of family labor can be also, if we want to be very specific and very particular about it, the family labor can be dichotomized in terms of whether uh, fully employed or unemployed or skilled or unskilled. Okay, so usually the cost of family labor is the opportunity cost of farm household labor. This is computed simply by adding the total number of labor in Mondays spent by the family, okay, multiplied by the daily wage. Okay, simple. Kung lima mo kabuok nagtrabaho in one day sa pamilya, or 5 times, pila ang wage rate, that is the cost of family labor. Kung nagtrabaho ko good for 30 days times 30, that is the total family labor. So, but normally, family labor is not an out of pocket cost. Okay? family labor is not an out-of-pocket cost. Pwera lang kung ang member sa family has his own house household already or living in another house where you will really literally pay him his share of the labor. But usually in the farm setting, if all of you are working and you're helping in the farm, it's an out it's a non out of pocket cost, but you get your share of the labor once it is computed, once it is once everything is deducted from the gross income, and what remains is the cost of farm family labor. Okay, so that one, cost of farm family labor, you have the cost and return analysis for cost and return analysis purposes. This, you mean the family labor normally is not deducted from gross income. Okay? I-deduct mo fertilizer, i-deduct mo na for example, you compute for uh, uh, say for example, uh, selling, I mean, price of the output, total value of the output, and then you have the total cost of the output, that and then total, like for example, price of the output. That means you have the gross margin minus now the different cost, the 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 fixed and the variable cost. Now in the variable cost, you have or yeah, it's part of the variable cost. You have there, for example, family labor. Now the family labor, once you compute the cost and return analysis, if you want to get the if you want to isolate the value of the family labor, deduct everything from the gross margin. What remains, deduct everything except the amount of the family labor. What remains is the share of the family farm labor income. Family farm labor income. Okay? Return to family labor, in other words. So, you have here income and profitability. Okay? Income can be either from income, the general measure of value addition from all production activities of farm business is net income. The gross minus expenses is the net income. It is obtained after deducting all relevant production cost expenditures from the gross income. Okay? Selling price selling price minus cost of sales, then you have the gross margin. Okay? Now, income and profitability when it comes to crops and livestock. Gross income is defined as the summation of all output from multiplied by its price. Pila ka sako, pila ka kilong vegetable times the price, pila ka sakong palay times the price, and so on and so forth. You multiply that and then add, you have the gross income for what? The gross income from crops. And then you also have the the livestock. Sum of all output produced livestock except those that are purchased. Some of those that are produced. And then you times the price, then you have the price for livestock or amount for gross margin for livestock. The other one is you have profitability, income and profitability measure. So you have profitability can be seen two in terms of two angles. One is undiscounted. When we say undiscounted, this is profitability using what? What particular values? Economic or financial? Undiscounted, it is financial values. That means to say you use in valuation purposes, you use the price, the nominal price of the good, the price existing in the market. So it can be undiscounted. The procedure would be net cash income, and then you have the minor. I mean, then you have net cash income, and then you have the gross margin or income above variable cost. When you say gross margin or income above variable cost, that means to say you deduct all variable cost except fixed cost. That means to say gross margin pa na, no? Now you have net income or return to owners, labor and management. Okay? The net income now, if you are not going to deduct, if you're not going to deduct farm labor income or farm labor expense, then what remains after deducting all associated expenses will be returned to owner's labor and management. The other one is return on investment or ROI. This is given in terms of the formula as you have here. You have adjusted net income. That means add back interest on borrowed capital, no? Add back interest on borrowed capital. Okay? Because ang kanang interest ko ana kana bitang na ay uh, part man na sa expenses pero imo nang i-add back, okay? Imo nang i-add back kay income na nga actual income. That means to say part na siya sa imong earned income. Okay? And then you have opportunity cost of labor, okay? OCLM. ROI is the uh, adjusted net income. What is an adjusted net income? Uh, Income generated after adding back interest expense. That means to say you have computation of like a net income and then of course na ditong interest expense. When you compute for ROI, i-add nimo nagbalik ang imong interest expense. Okay? Adjusted net income. That means you have an AI or adjusted net income. Minus, you have what? Opportunity cost of labor and management. Okay? Opportunity cost of labor and management. That means you have it's either okay, it's either you have the return to labor or the what? The labor, no? The labor that is actually uh, undervalued from the point of view of financial prices. Meaning to say, okay, meaning to say, from the point of view of financial prices, if for example, ang labor nimo gigamit is wage rate, nominal wage rate, kung unsa na ang labor, kung skilled na, ang economic value ang imong gamiton. That is the opportunity cost of the labor. Okay? So that means it will also appear higher, normally higher kay the wage rate outside of the country is actually higher than what is available locally. Okay? And then you have TI or total investment divided by total investment. Pila gyud ang investment sa machineries, etc. Capital, add na tanang investment times 100%. Okay? So that means to say the decision rule for ROI is that the rate that should be generated after computing ROI, okay, the rate or the value that should be generated must be higher than bank rate. If you have an ROI of 25 and then when you borrow money from outside source is only 18%, you borrow money, or if you like borrow money from the bank, it's only 18 or 15%, and the ROI that you get from computing this from your enterprise is 25%, then the ROI is very much desirable. Okay. So, income and profitability, you have also discounted and undiscounted method. Here, we need to compute for discounted measures. Okay? That means to say, what is the difference between discounted and undiscounted? When you discounted, it is computation of the rate of return at that particular year. At that particular year. While discounted is a computation of rate of return over a period of several years. Okay? That is discount. I mean to say you use discounting procedure. You have this in your finance. Okay? So that using that, discounting measures, we can either use NPV, IRR, or BCR. Okay? For NPV, you can compute that using the what? Using the normal formula or the formula available in your computer. You can use NPV computation there. And so do with IRR. We will tackle more specifically on what is the difference between the three, no, in the next lecture. Okay, I will dwell more specifically on how to compute for NPV, how to compute for IRR, and how to compute for BCR or benefit cost ratio in the next succeeding lecture. Right now, I suppose it to say, or yeah, I would like to that it's the end of this lecture, and I hope that you go over this material so that you'll be able to review them and familiarize. No sweat. The method introduced here is very easy to follow. With that note, I thank you, and I'll stop sharing. And also, you have uh, um, like